Welcome to this explainer. If you've been trying to navigate these crazy, volatile markets lately, or maybe you're just trying to figure out what to do with a sudden influx of cash, you've probably felt totally stuck between a rock and a hard place. It's like you want absolute safety for your money, right? But you also absolutely hate seeing your returns just get eaten alive by high taxes and inflation. Well, today, we're going to break down the mechanics, the performance, and the strategic uses of the ICICI Prudential Arbitrage Fund, just to see if it might actually be the right safe harbor for your cash.
Okay, so here is our roadmap for today. First, demystifying arbitrage mutual funds. Then, we'll look inside ICICI Prudential Arbitrage, break down the risk metrics and volatility, and jump into some benchmark and peer comparisons. After that, we'll cover the ultimate tax advantage, and finally, strategic moves for beginners.
So starting with part 1, demystifying arbitrage mutual funds. To really get this, we first need to look at the exact problem this instrument was built to solve.
Think about this for a second. What if you could get the amazing tax benefits of equity funds, but with the super low risks of debt funds? Would you take that deal? If you're a conservative investor or maybe a beginner just looking to park some cash without losing it to taxes or a sudden market crash, you've probably faced this dilemma. Traditional fixed deposits feel incredibly safe, sure, but man, they are taxed so heavily. And equity funds? Very tax efficient, but way too volatile for a short-term parking spot. So how do you get the best of both worlds?
Enter arbitrage mutual funds. Basically, these are market-neutral schemes. They aim to capture the price differences between the cash market and the derivatives market, which keeps their volatility exceptionally low. It's kind of like a really risk-averse merchant. Instead of placing a risky bet on where a stock's price is going to go tomorrow, they just pocket a guaranteed spread between two entirely different markets.
The core mechanism is actually brilliant in its simplicity. By simultaneously buying a stock in the cash market and selling it in the futures market, the fund manager literally neutralizes the market direction. If the stock goes up, the cash holding gains, but the futures contract loses. And if it goes down, the exact reverse happens. So the direction of the market doesn't even matter. The fund simply locks in that price differential, that little spread, between the two.
All right, moving on to part 2, inside ICICI Prudential Arbitrage. Let's see how our primary case study today actually executes this strategy at scale.
Just look at this staggering number. Over 33,400 crore rupees in assets under management. That is massive. This single fund captures nearly 10% of the entire domestic arbitrage mutual fund market. And you know what that scale proves? It shows this is a major, highly liquid vehicle that's trusted heavily by big institutions for capital preservation. Peeking right under the hood, we can see exactly how they're deploying all those billions. The fund maintains a very precise 71% exposure to equity. Now you might be wondering, why that specific number? Well, it's because crossing the 65% threshold legally secures its highly favorable equity tax status. Meanwhile, they use roughly 29% in debt and money market instruments just to ensure absolute stability and liquidity. And if we break down that equity portion even further, it reveals a deeply, deeply conservative approach. Nearly 78% of the equity is parked super securely in large cap stocks. We're talking highly liquid blue chip companies like Reliance and HDFC Bank. There is almost zero exposure to the crazy, erratic small cap space. So the risk factor here is kept incredibly low, which perfectly aligns with our whole mandate of capital preservation.
Okay, part 3, risk metrics and volatility. Because it's easy to call a fund low risk, right? But let's see what the actual technical metrics tell us about how it handles market turbulence.
So first off, the standard deviation, which basically measures how wildly returns swing from the average, is incredibly low, sitting well under 1%. But the absolute standout metric here? It's that beta of 0.00. Beta measures sensitivity to the broader stock market. So a beta of exactly 0 means this fund has literally zero systemic sensitivity to the market's wild swings. If the Nifty crashes 10% tomorrow, this fund is mechanically designed to remain completely indifferent. No panic whatsoever.
Building on that, we see a positive alpha, which tells us the fund managers are successfully capturing those pricing discrepancies to generate excess returns beyond market expectations. Plus, look at the Sortino ratio reaching up to 3.90. Now, while a Sharpe ratio penalizes all volatility, Sortino focuses exclusively on the bad kind, downside deviation. A score this high mathematically proves that negative return anomalies here are exceptionally rare and super well controlled.
Let's dive into Part 4, benchmark and peer comparisons. Because, let's be honest, metrics don't mean much in a vacuum. We need to weigh this fund against its rivals. Starting with the benchmark, while the ICICI fund is an absolute powerhouse of a safe harbor, it has slightly trailed its Nifty 50 arbitrage benchmark over the recent 1-year and 3-year periods. Delivering 6.01% versus the benchmark's 7.2% over 1 year is a slight drag for sure. But honestly, this is just a natural byproduct of managing a colossal 33,000 crore AUM. It's like steering a massive cruise ship. The sheer size naturally limits the agility needed to chase after every tiny, fleeting arbitrage spread out there. However, when you contrast it against its major peers, the ICICI fund consistently holds its ground. Delivering that 6.01%, it effectively edges out massive competitors like Sundaram and DSP, and it vastly outperforms smaller funds like Samco. It offers a highly robust, competitive yield without sacrificing an ounce of the sheer stability that its massive size provides.
Part 5, the ultimate tax advantage. Let's clear up a major misconception that beginners often have with these growth metrics.
Seeing steady, positive returns rolling in year after year, well, it might really tempt you to view this as a long-term capital growth engine. You might look at a 6% return and think, hey, not bad for zero risk. I'll just park my retirement money here for 20 years. But is that the reality? Let's unpack that right now.
Actually, scratch that long-term idea. Pivoting from myth to reality, financial experts at Value Research explicitly advise that this fund is a defensive, short-term parking space for idle cash. It is absolutely not a wealth creator. Its low volatility metrics mean its returns are really only meant to keep pace with inflation and preserve your principal over a short horizon of, say, 3 months to 1 year. If you're trying to double your money over a decade, this is definitely not the vehicle for you.
So, what's the point? Well, the true magic of this fund doesn't lie in compounding, it lies in the tax code. This is the real game changer. Because it legally holds over 65% in equities to run its strategy, the government actually taxes it as an equity fund. That means short-term capital gains are taxed at just 20% and long-term capital gains at 12.5%. If you are in a 30% or higher income tax bracket, utilizing this fund is vastly more tax efficient than keeping your cash in a traditional fixed deposit, which just gets hammered at your highest standard rate.
And finally, Part 6, strategic moves for beginners. Now that you know the mechanics and those highly favorable tax rules, how do you actually put this to use today?
A brilliant strategic move, and one used heavily by institutions, by the way, is to use this fund as the base for a systematic transfer plan or an STP. Let's say you just sold a house, right? Dumping all that lump sum cash directly into a volatile stock market all at once is incredibly risky. Instead, you park it in this arbitrage fund to earn those tax-efficient, market-neutral yields. Then, you set up an automated STP to slowly, safely phase fixed amounts into riskier equity markets over the next 6 to 12 months. It's safety, tax efficiency, and responsible market entry, all wrapped into one strategy.
Which brings us to our final thought for today. Are you letting your idle cash just lose value to inflation and high taxes when a perfectly hedged safe harbor exists right in front of you? By understanding the clever mechanics of arbitrage, you can literally stop leaving money on the table. I really hope this explainer empowered you to rethink your short-term cash strategy and maybe leaves you wondering what other tax-efficient moves might be hiding in plain sight. Keep exploring, and I'll catch you next time.